Today, we're going to pull back the curtain on one of the most misunderstood concepts in all of finance, the vast and often treacherous gap between a company's profit and its cash. See, one is essentially an opinion, and the other is a hard fact. And learning to tell the difference, well, that's the key to understanding what's really going on inside a business.
So let's start with a question that seems to break the very laws of business. How is it possible for a company to be all over the news, reporting record-breaking profits, with investors cheering from the sidelines, and then, just months later, it's completely out of money, filing for bankruptcy? This isn't some academic thought experiment. This is a brutal reality that has destroyed giants. The answer lies in that gap I mentioned, the gap between perception and reality.
And this really frames the entire conflict. On one side, you've got profit, and I want you to think of profit not as a number, but as an opinion. It's a structured, well-argued opinion, sure, but it's still an accountant's estimate built on rules and assumptions. Then, on the other side, you have cash. Cash is not an opinion. Cash is a fact. It's a physical thing. You either have it or you don't. Profit, you see, tells a wonderful story, but cash is what pays the bills.
So, if profit is an opinion, how exactly is that opinion formed? This takes us right to the heart of the machine that creates this disconnect. A system that, for all its good intentions, can sometimes weave a story that's beautiful, but beautifully misleading.
That system is called accrual accounting. It's the standard for pretty much every major company, and its goal is actually quite noble. It tries to match economic activity to the right time period. So, if you make a big sale in January, it gets recorded as January revenue, even if your client isn't going to pay you until, say, April. It's designed to smooth things out, to give a clearer picture of performance. But in doing so, it creates a very dangerous time lag.
Let's make this super simple. Imagine a company makes a $10,000 sale. The second that contract is signed, boom, accrual accounting says they can book that revenue. On the profit and loss statement, they look great. But then, the wait begins. The invoice goes out, but for the next 90 days, there is absolutely zero cash to show for that amazing sale. Meanwhile, they still have to pay salaries, rent, suppliers, all with very real money. The actual reality of that profitable sale doesn't arrive until 3 months later, when the money finally hits the bank.
And this is the weak point. This is the vulnerability in the entire system. This gap, this chasm between the story of the sale and the reality of the cash is where all the financial illusions are born. It's a gray area, a space of estimates and subjectivity, and it's a space that's ripe for exploitation.
So how exactly does a company exploit that gap? Well, there are a few common ways, and they range from some subtle tweaks in the accounting all the way to decisions that are actively destructive to the business in the long term, all just to hit a short-term profit number. First, you've got the classic accounting games. Things like adjusting estimates. Maybe a company decides that fewer of its customers are going to default on their payments than is probably realistic. Or there's the big bath, where in an already bad year, a company writes off every possible loss they can find. Why? Because it makes the next year's profits look spectacular in comparison. But the most dangerous tactic of all is something called real activities management. This isn't just fudging the numbers, this is actively harming the company. This is when a manager kills a crucial R&D project or slashes the marketing budget, literally sacrificing the company's future just to make the profit number look good for the next 3 months.
And please, don't think this is just some academic theory. These are the exact mechanisms that allowed for some of the biggest corporate frauds we've ever seen. WorldCom, Enron, they were absolute masters of exploiting this gap between the accounting story and the cash reality. And it led to collapses that were just catastrophic, vaporizing billions and billions of dollars of investor money.
Okay, so if the profit and loss statement can tell such a convincing lie, where do we turn for the truth? Fortunately, there's another report, a document that's much, much harder to fake. You could almost think of it as a company's financial confession.
And what if I told you that with just 3 numbers, you could diagnose a company's entire life story? You could see if it's a hungry startup, a superstar in its growth phase, a stable, cash-printing machine, or a dying business in its final days. That is the incredible power we're about to tap into.
The document is called the Statement of Cash Flows, and its purpose is both simple and profound. It just follows the money. It completely ignores all the accounting estimates, all the opinions, and focuses only on one thing: cash in and cash out. It's like a financial lie detector because it forces the company to show how it got from its stated profit to the actual change in its bank account. And it does this by breaking the company's life down into 3 distinct stories. First, operations. is the main business, the thing they actually do, generating cash. Second, investing. Is the company spending cash on its future, building new factories, developing new tech, or is it selling off its assets just to survive? And third, financing. Is it borrowing money or getting it from investors, or is it so strong that it's actually paying down debt and buying back its own stock?
And what's amazing is how these three stories, when you look at them together, paint a vivid picture. A startup, it's burning cash in its operations and investments, all funded by cash coming in from investors. A mature, healthy company, the dream state, is a cash machine. It generates tons of cash from its operations, enough to fund its own growth and still have plenty left over to reward its shareholders. In a company in decline, it's the tragic opposite. It's selling off assets just to cover the losses from its day-to-day business. These patterns tell a far richer, far truer story than any single profit number ever could.
This all leads us to the ultimate question in finance. It's not about how much profit a company reports. It's about how much cash it can generate. Because at the end of the day, that's what a company is truly worth.
And the metric that captures this is called free cash flow. The concept is just beautifully simple. It's the cash that's left over after a business has paid for everything it needs to run its operations and to make all the necessary investments to stay competitive and to grow. This leftover pile of cash, that's what truly belongs to the owners of the business. It is the ultimate measure of a company's financial power.
So this creates a stark choice in how we think about value. The most common metric you hear about, the P/E ratio, is based on profit, the opinion. It's really just a popularity contest, and it's vulnerable to all the games and manipulations we've talked about. A far more robust way is to use the free cash flow yield. It's based on fact. It ignores the popularity, and it asks the only question that really matters. How much actual cash is this business generating compared to its price?
Now, of course, we have to be intellectually honest here. We have to ask the question, is the statement of cash flows completely foolproof? Can this document be forced to lie too?
And the answer is yes, it can be distorted, but, and this is a huge but, it is much, much harder to do, and the tricks don't last. A company might try to move a routine expense from the operating section to the investing section, for example, or they might sell off their future customer invoices to get a quick hit of cash today. But these are short-term fixes. You can only sell your future once. And these kinds of games create patterns over time that become glaring red flags for any analyst who's paying attention.
Which brings us back to where we started, to this fundamental truth. Profit is an accountant's opinion. It's a useful story, a polished narrative of performance. But if you want to know if a business is truly alive, if its heart is strong, if it's built to last, you don't read the story. You listen for the heartbeat. And that heartbeat is not profit, it's cash flow.